Welcome back to the program. Great to have you with me. Please take a moment to subscribe to the channel if you haven't already. Click that like button. So a couple of quick things to talk to you about today. Some economic data from last week and President Biden's response to the ongoing attacks against U.S. soldiers in Iraq, Jordan, the Gulf of Aden, the Red Sea, from who appear to be Iranian-backed proxies in the region. So I want to start with some GDP data we had last week, late last week. Q4 gross domestic product was released by the Bureau of Economic Analysis. And there's been quite a bit of cheering on the part of Democrats. Obviously, they're supporting their president. And we want the country to do well no matter who's in the office, but a little bit over the top. So let's run through the report and I'll give you some insights to what I'm talking about. So according to the Bureau of Economic Analysis, real gross domestic product increased at an annual rate of 3.3% in the fourth quarter. That's an annualized estimate. And this is the advanced release. We'll get two more releases, one in February and one in March, including more data. In the third quarter, real GDP increased by 4.9%, again, annualized. Current dollar GDP, not accounting for inflation, increased 4.8% at an annual rate of $328.7 billion in the fourth quarter to a level of $27.94 trillion. Now that's a nominal amount, including current prices, but still a monster number. 340 million people, 27.9 trillion, by far the largest economy on the planet. For all of 2023, real GDP increased 2.5%, compared with an increase of 1.9% in 2022. Joe Biden has yet to have a yearly GDP print above 3%, very much like his boss from 2008 to 2016, President Barack Obama. The increase in real GDP in 2023 primarily reflected increases in consumer spending, state and local government spending, exports, and federal government spending. So there's a theme there. The personal consumption expenditures price index increased 1.7% compared to an increase of 2.6%. Good news there. It's a measure of inflation. Remember, the inflation is the rate of change in the price level. So prices are still rising at a decreasing rate, and the price level is probably up about 18% since President Biden took office in January of 2021. Excluding food and energy prices, those volatile components, the PCE price index increased 2%, the same as in the third quarter. Disposable personal income, the money we have after taxes and deductions, increased $211.7 billion, or 4.2% in the fourth quarter, compared with an increase of $143.5 billion, or 2.9% in the third quarter. Real wages are still down over the past 3 years, but in late 2023, real wages have actually begun to rise as the rate of change in nominal wages is higher than the rate of change in inflation. Personal savings was $818.9 billion in the fourth quarter, compared with $851.2 billion in the third quarter. So consumers and households dipped into the savings account. The personal savings rate, personal savings as a percentage of disposable personal income, was 4% in the fourth quarter, compared to 4.2% in the third quarter. We have historically always had a low savings rate, and that's part of the reason why we have a massive trade deficit with the rest of the world. So what I'm after here is, while GDP print was a good number, it was driven largely by government spending, which for you and I means more deficits and more debt. Now, many economists, including myself, have been calling for a recession for late 2023, early 2024, and it just hasn't happened yet. The last recession, 2 consecutive quarters of negative real GDP growth, occurred in Q1 and Q2 2022. So the main driver of GDP growth since that time has been government spending. For 2023, federal, state, and local government spending set a new record high of $9.64 trillion, more than double total government spending from Q1 2017. This is largely driven by President Biden's deficit spending since 2021. While the Fed has increased the federal funds rate, the overnight rate, to 5.5% since mid-2022 to slow the economy down and wring out inflation, deficit spending and increasing debt levels on the fiscal side have offset this increase in rates to keep GDP going up. So probably not sustainable. We'll take it as a good number for sure, but just some qualification there on the excitement for those supporting the president. And again, I want to support him too, but let's be clear on the data. All right, some other things I want you to pay attention to this week. Tomorrow, Tuesday, the Federal Reserve's Federal Open Market Committee, the committee that sets the interest rates for the economy, the federal funds rate, the overnight rate banks use to manage their daily reserve requirements, is set for a decision on Wednesday. The meeting starts Tuesday, a two-day meeting. On 2 p.m. on Wednesday, they'll announce their decision. Market expectations are for the Fed to hold interest rates unchanged at 5.5%. I think this is a mistake. I think should go a little higher in Fed funds. I think we need another quarter basis point increase and an extended period of time of stable interest rates. Many in the market are looking for lower interest rates in 2023. And dovish statements out of Fed Chair Jerome Powell at their December meeting kicked off this unbelievable rally we're seeing in stocks over the past couple months. Sell these rallies. Sell these rallies. Stock market's out of control. It's mostly a short squeeze and very narrow breadth. Not a lot of stocks are causing these big changes in the indexes like the Dow and the S&P 500. The other thing we want to pay attention to for this week is Friday. The first Friday of every month that is not the first day of the month is the release of the Employment Situation Report from the Bureau of Labor Statistics. This will be the January report. And in this report, we get a look at net job growth in January, looking for 173,000 net increase in jobs. Not bad, a little weak. Looking for average hourly earnings of 0.3%. The U3 unemployment rate, the narrowest measure, to go to 3.8%. The U6 rate, our broadest measure, to be around 7.3%. We also get average weekly hours. So the whole world will be paying attention to this data point on Friday. It's the mother of all data points. So pay attention for that. Let's pay attention for revisions in November. What's been happening for the past year, every month we've had a revision to the prior month's data to the downside. So November printed 216,000. Let's take a look at what happens on Friday, see if that number is revised down and keeps the pattern alive for the past year and a half or so. And then lastly, just let me mention the attack on our base in northern Jordan over the weekend by what we believe to be Iranian-backed proxies coming out of Iraq. It's not sure if the attack actually came from Iraq or Syria. 3 American soldiers were killed, 25 injured. Questions are becoming quick and fast. And one of the obvious questions is, first, how this happened? Why don't we have air defense systems in place to take these drones down? And why is President Biden being so soft on Iran? Since October 7th, there have been dozens of attacks on U.S. soldiers in the region, Iraq, Jordan, Syria, and on our naval warships in the Gulf of Aden and the Red Sea. President Biden has done some pinprick responses, but nothing very aggressive. And so people are scratching their head wondering what's going on. Of course, President Biden was vice president when President Obama tried to appease Iran. Donald Trump reversed that and imposed sanctions and clamped down on Iranian activities. When President Biden became president, he again reversed that and tried to work another deal with Iran. In 2023, he fought to release $6 billion that was on hold at a Korean bank that belonged to the Iranian government and released that money to the Iranians. And so the question becomes, what is keeping President Biden from being more aggressive in response to the attacks on the U.S. military? And let me suggest a reason. Election 2024. That the president may be trying to slow walk this or pinprick his way out of this so as not to disrupt oil prices and the flow of oil out of the Middle East into the rest of the world. Speculative right now, but I'm hearing more and more talk amongst my economist friends about this. Such is the power of election if it's true. Let's hope it's not true. And of course, the president should be doing all he can at all times to protect U.S. forces on the ground in enemy territory. All right, that's all I have for you today. Always try to buy American.